Forgot to do that. Okay. Welcome to the podcast for Chapter 16. In this podcast, we're going to deal with cash management and a little bit with accounts receivable management. So, cash management, first of all, is a very big field. We're going to talk just 5-10 minutes on it, but there are courses on this called Working Capital Management and Cash Management. Large organizations have a treasury department in which cash managers work in relationship to the treasury. And so this is a significant component of large businesses especially. So what are some of the motivations for holding cash? Well, we might keep cash on hand because of transactions. We need to have it on hand so we can make payments. We want to have some on hand for precautionary reasons, right? Something unforeseen coming up. We might have something for speculation. We have cash available to purchase investments or some unique opportunities, and we might have to do it because of requirements for our compensating balances. Okay, for most businesses, they don't want to keep cash on hand, so they want to keep cash as little as possible, primarily because cash earns them little to no interest. So it's expensive to maintain significant amounts of cash on hand. Certainly, it's easier and more efficient to run a business with lots of liquid cash. You have cash around, you can do things very quickly. But the key is, right, we want to have a balance between the two. If I have $1 billion of cash on hand, I'm not running my operations as efficiently as possible. So what can we do with our cash? Well, one of the things, we can invest in marketable securities. So marketable securities are assets. They are only slightly less liquid than cash, and they earn a return unlike a checking account. They tend to be like treasury bills and other short-term securities by very stable organizations that are going to have, usually the maturity is 3 months or less. All right, check disbursement and collection procedures. Let's go through some of these ideas of how companies can manage and increase cash receipts. So here's a basic procedure. A payer writes a check and mails it to the payee. Maybe this takes 1 to 2 days in the mail to arrive. The payee receives it, they process it, that's another day. They send it to the bank, their bank, that's another day. Their bank then sends it to the Federal Reserve clearinghouse to make sure the check is good. That takes a couple more days. So it's possible that might take 7 days from the time that you write a check before that money comes out of your checking account. And that time period we call float. So float is how long that money sits in your account while it goes through this process. Generally, payers want to extend this time. If I'm a business and I've written the checks, I want to hold on to that money as long as possible, because again, it allows me to maybe invest in short-term investments or something like that. The payees want to reduce the time. They want to collect that cash as soon as possible. So that's sort of the traditional method, right? The traditional method is we ship checks around the country. There are some more innovative ways to do that. Banks are trying to they truncate checks with the idea of trying to speed up the clearing process, but this is kind of slow and it's just done at the discretion of the individual banks. So again, this is sort of a graphic of the check clearing process. So the payer mails it 2 to 3 days. Maybe there's a couple days of internal processing as it goes to the bank, goes to the Federal Reserve. Now it comes out of this bank account and back to the payee. All right, and I have a little video to show you. I don't know how many of you have seen the movie Catch Me If You Can. It's based on a true story of a person in the 60s, in this part played by Leonardo DiCaprio, where he was modifying checks in order to increase the float.
Our next item up for bid is also from the Jersey Central Bank foreclosure. This is a micker encoder, a machine used to encode bank checks. Do I have an opening bid?
Our unknown subject is a paper hanger who started working on the East Coast. In the last few weeks, this unsub has developed a new form of check fraud, which I'm calling the float. What he's doing is he's opening checking accounts at various banks, and then changing the Micker Inc. routing numbers at the bottom of those checks. Next slide, please. Next slide, please.
The remote thing is broken. You have to do it by hand. You gotta try to.
Agent Mullen, it should be the square button just there by the
That
side.
carousel doesn't work. It's that
Lower.
bad carousel you got.
Thank you,
You
Agent
got to
Mullen.
move it manually.
This is a map of the 12 banks of the U.S. Federal Reserve. Slide. Micker scanners at every bank read these numbers at the bottom of a check. Slide. And then ship that check off to its corresponding branch.
Carl, for those of us who are unfamiliar with bank fraud, you mind telling us what the hell you're talking about?
The East Coast branches are numbered 01 to 06. The central branch is 07, 08, so on and so forth.
You mean those numbers on the bottom of a check actually mean something?
All of this was in the report I filed 2 days ago. If you change a 02 to a 12, that means that check, which was cashed in New York, does not go to the New York Federal Branch, but it is rerouted all the way to the San Francisco Federal Branch. The bank doesn't even know the check is bounced for 2 weeks, which means our unsub can stay in one place, paper the same city over and over again while this check circle the country.
You know, you want to talk to my wife. She's the one balances the checkbook at our house.
Next slide.
Okay, so you can see from that short video, the problem with that, the fraud that was being committed is because there's the changing the routing number. It wasn't the check wasn't clearing within a day or two with the New York Federal Branch. It was being shipped to San Francisco, which obviously in the 60s took some time. It gets shipped back to let them know that it was no good, and that was creating 2 or 3 weeks worth of float. Okay, so how do businesses accelerate cash receipts? Well, one of the ways they do it is with a lockbox system. And a lockbox system provides what happens, I guess, with the lockbox system is that a bank will collect receipts from a company rather than having the customer send it to the company directly. So, for example, I live in Salt Lake City. If I'm going to pay my credit card bill and I write a check, and my credit card is out of Delaware or North Carolina, where a whole bunch of them are, that's going to take a few days to, again, send that there. They get the check, they process it, it has to send it back to my bank. So what credit card companies and others do is they tend to, when they send you your bill, their address is something usually quite local, a large city that's fairly close. That's actually technically a bank. You're not sending it to any headquarters of theirs, you're sending it to a bank where the bank collects that, and that accelerates the collection. Once you have all of these lockbox banks all around the country, then at the end of the night, they sweep all of that money into a centralized account. So here's the idea, right? Now, instead of, for example, me sending it across the country, now I'm paying something local, so it's just 1 to 2 days. It goes to a bank, so that immediately puts it into the account. It doesn't have to be handled by the payee anymore. And again, if it's in a local bank or something which is in the same Federal Reserve, then it speeds up the days to take that out of my account. So it's a way to speed up that process. Wire transfer is another way to do it, electronic transfer. Many of you probably have something like that. We call them EFT receipts or EFT payments. EFT is electronic funds transfer. If any of you get paid with direct deposit, that's an EFT. If any of you make any automatic payments, that's an EFT. How these things get swept up is what's known as a ZBA account. So these lockbox accounts are zero balance accounts. At the end of every night, whatever they've collected gets swept up into a central clearing bank, or account. Those accounts then are usually let's just use an example. Let's say my business, I sweep up $20 million in one day. The bank then notifies me what checks I'm going to have clear. And let's say on this particular day, they say I'm going to have $10 million worth of checks clear. Well, I've swept $20 million into the account. I set aside $10 million to pay that, and now I can move $10 million into maybe some type of interest-bearing account. That's kind of a very simplified view of what cash managers do. Okay, managing accounts receivable is the final part of this podcast. The reason the companies have accounts receivable, of course, is if you extend credit, you can increase sales. So it is a balance between when do we increase sales and what happens when we sell to people who are financially weaker customers. If we have higher receivables, it means that we likely have a higher risk of not collecting from some of those. So our receivables policy includes our credit policy, who we're going to lend to or sell to on credit. The terms of the sale, this is like our 210 net 30. And by the way, if we extend this, that gives us higher accounts receivable. And our collection policies, when are we calling, what kind of letters are we sending, things like that. So credit policy examines the creditworthiness of potential customers. If we have a tight credit policy, that's going to lead to lower sales. If we have a loose credit policy, it's going to lead to higher sales, but also an increase in our bad debt expense. Credit terms, again, these are when we expect payment. 210 net 30 is the most common term. Customers receive 2% discount if they're paid within 10 days. Otherwise, the entire amount is due in 30 days. They give us a way to speed up that process. And finally, the collection policies. How do we collect from customers that aren't paying? How do we follow up on overdue receivables? That's called dunning. By the way, I didn't know that, so I learned something from this process too. So we mail letters, we follow up with more aggressive letters, phone calls, etc. All right, that is our podcast for cash and accounts receivable management.